home prices have started to stabilize. And I think market by market, you're going to see actually some home prices have dipped a little bit. But your hot markets, Austin, San Francisco, obviously New York, Florida, many of the coastal areas, those are always going to remain high. And the expectation is when you purchase a home in those places, you're always going to see home price appreciation. But it will stabilize if I were to guess. And I think a lot of it is going to have to depend on the housing inventory.
Welcome to Actualizing Success. In this podcast series, our in-house advisors discuss today's finance and technology topics with an emphasis on solutions that embrace tomorrow.
Hi, this is Matt Sue, partner with Actualize Consulting. And with me today is EJ Kite. EJ, would you like to introduce yourself?
Thanks, Matt. EJ Kite. I'm just excited to have an opportunity to talk to you folks today about what's going on in the mortgage industry and what we're seeing, and looking forward to any commentary we get back.
All right, very good. So EJ, I mean, we all know it's been a really interesting few years, really the last three, I suppose. I mean, after the run we've had with rates being artificially low, we remember that pretty well, but even going farther back, even 20 years back, there's been a lot of interesting things. And just curious, I mean, you've been in the business for as long as I have, or even more, really. What do you think when looking back over the last 20 or so years? What are the biggest things that stick out to you?
It's a great question, Matt. I was actually talking to some friends about this a few weeks back. They're interested in buying a home. And I guess what has shocked me the most, if you go back to 2000, most folks probably don't remember this, but interest rates were over 8%. And home prices were, they were escalating, but they were still moderate for the time. And over the 21 years, let's say from 2000 to 2021, what we saw was interest rates steadily coming down while home prices steadily went up. And what was key about that is I guess one of the biggest costs in buying a home is the mortgage payment. And because rates were coming down while prices were going up, that mortgage payment really didn't change for about 21 years. It stayed relatively the same, between $1,200 and $1,400. And that was intriguing to me because the last 3 years, as you pointed out, rates flipped and home prices really flipped. And so with median sales prices well into the 400s and interest rates at one time, I think the last 3 years, over 8%, what that caused was a mortgage payment to go from, like I said, $1,200, $1,300 to now $2,700. So to me, that was the most interesting thing that's affecting, my friends who are trying to be first-time homebuyers and anyone in the space trying to buy a house if they're moving and things like that. So that was really, it was very key finding for me.
I agree with that. I remember my first mortgage, I think, was at like 10%. But that, again, was on the heels of some that were 18%. So, again, I mean, just a really, really different time. And when you look at it, much of the existing book that's out there is still way under 5%. I think there's quite a bit, even in the 3 and 3.5. And we know that's going to be staying around for a long time. And of course, we had our bet on how much rates were going to get cut. I didn't get it right. I'm not a great prognosticator. But we do see the Fed looking to maybe move some rates down in the coming months. I'm not sure. I think the election probably will determine some of that. But you think about, let's look into the crystal ball out a few months. What do you think is going to impact the housing market, rates or otherwise?
Well, to your point, I think studies have said that, the bulk of the mortgages have a rate below 6%, 80, 85%. And so with that 50 basis point rate cut that most people felt was baked in to the rates, because I think rates are still over 6.3% today. I'm not a prognosticator, but I don't think refinancing is really going to hit for a number of months and potentially well into 2025, even if the Fed does continue to cut rates. What's concerning about that is the folks who did buy a home the last few years. I'd say the bulk of them were those Generation Z folks, were born before 2012, their rates are over 7%. So for them to really consider doing anything, I'd like to see rates probably close to 5.5% because, as you know, when you refinance, there's still costs that are associated with that. These people most likely bought their first home, put 5-7% down, maybe more. They don't have any savings left, and that's been one of the, I guess, the downside to these rates dropping. Is we're going to see savings rates on CDs and other places. They're going to start to drop off too. So I don't know if folks are going to have enough money to save or enough money saved to even consider doing a refinance in the coming months. That's going to be a concern.
So what do you think about those with the really high rates? Do you think they're gonna?
I think they have two choices: stay with what they have, they can afford it, or hope for maybe, like you said, the presidential election. Maybe there's could be some tax cut to give them more money in the pocket. But what I think they're going to do is they're going to either sell their house, go back to renting, because renting is still cheaper to buy. It has been for the last 18 months or so, maybe even longer, or they're just going to have to wait it out. If it does drop below 5.5%, it's likely those 7.5ers might refinance. But I think you were mentioning like your first mortgage rate was 10%. Where we sit today, short-term memory is when it was at 6%. If you go back 15 years, that was a pretty good rate. Most of us really we would have loved that. But unfortunately, those periods of time, after COVID, when the rates dropped to below 3%, that's what people think was or is the new normal. So we're still in a really good position, 5.5%. But I think they're going to have to consider those high mortgage rates over, say, 7.5%. They can save quite a bit of money if it does come down below 5.5%.
In terms of my crystal ball, my take is that if Harris wins the election, we'll see a continued focus on affordability. If Trump wins, I think he's going to be quick to try to cut rates in order to stimulate the economy, et cetera, et cetera. But the real question that I have to think about is how far can you go? Because really, when you think about mortgages at 3%, it was basically essentially free money. I mean, these banks were borrowing at almost zero. And I just don't know that we're really going to get to that in the long term. I think the biggest impact has actually been the perfect storm of home price appreciation, rates where they are now, and the very limited amount of housing supply, be it new housing starts or what have you. So I think, again, very unique. I'd be surprised if we saw it go down that low again. And I'll ask you another question. I mean, you had mentioned steady increase in sales prices. This is really tricky, but do you think that we're going to see a continued growth, or do you think that we're going to see some leveling in terms of that?
It's interesting. I think home prices have started to stabilize. And I think market by market, you're going to see actually some home prices have dipped a little bit. But your hot markets, Austin, San Francisco, obviously New York, Florida, many of the coastal areas, those are always going to remain high. And the expectation is when you purchase a home in those places, you're always going to see home price appreciation. But it will stabilize, if I were to guess. And I think a lot of it is going to have to depend on the housing inventory. Normal amounts of inventory is, I guess, active listings, I guess we'll call it that, is somewhere north of 1.2, 1.3 million active listings. And we're still well below a million. And that to me is driving a lot of this home price appreciation. It's the old economics 101, with no supply and plenty of demand, people are paying more. But just anecdotally here in Dallas, Texas, where I live, and in my neighborhood and surrounding neighborhoods, I do see homes for sale, and they're not selling as fast as they were a couple of years ago. I mean, you remember, they put a sign out front and it was gone in a week, or had a pending or a sale on it. I'm still seeing homes sitting there for more than a month. And I think that's because they're still waiting to see what's going to happen maybe with another rate cut. Are we going to see that maybe lower rates so people do want to buy? So it's going to be regional, Matt. I think depending on where you live, you might see some steadiness and you might see some decline.
Yeah, I'll also comment. So I have some personal real estate holdings as rental properties. And what I've started to see is that some of the very low priced properties are starting to come onto the market. So for a really long time, you saw those properties get gobbled up by flippers or those that wanted to buy and rent. And it seems like that price point or that type of housing is coming more onto the market. It actually would fit the definition of first-time home buyer, but at the same time, these are properties that are generally in areas with high amount of rentals in the neighborhoods, the apartment buildings or condos and such. So that's a little bit of an indication, I think. And I also see that the ultra high price properties in certain geographies are just sitting there. So again, a little bit of a barbell effect on that, and such. So give you an example, and I want to get your opinion on it. My son is single, young guy, makes a little bit of money, but not much, in a very high cost of living area in the U.S. And, he's got a lot of headwinds. Of course, his credit's real good. But if you were to advise people that are looking to become first-time home buyers, what are the things that you think would have to change as we go forward in terms of that? And just what are we up against here?
Yeah, and my stepson's 13, so he's got a ways to go. But we've been talking to him about saving and what it's going to cost to afford everything. And it's not just home prices, but it's the cost of insurance. It's cost of all the utilities are going up. So for my friends who are now looking to buy, what I've talked to them about is you really need to save your money. So the savings rate's got to be pretty high. That's easier said than done. We know it's very difficult to save, especially in these high prices. So as housing inventory comes back, prices stabilize. For first-time home buyers, there's some great programs out there they can look at. And in particular, there might be some home affordability programs that could address folks that want to get into the market. We do have a friend in common that his daughter works for the county, and she was able to get aid to get her first home. I think that's tremendous. And I think every county and state probably has similar programs for them. So, unless they're going to get help from, a parent, coming up with 5% down, still a lot of money on a $300,000 house. And, what they do, my friends are doing is they've got roommates. And as they get roommates, they're able to save a little of money. It's not pleasant, but, that's what they're having to do. And they cross their fingers that rates will come down and, home prices might stabilize. So one other thing, too, I'll mention is sort of another whammy, if you will, is foreclosures, which are another avenue for first-time home buyers. Although we're in a fairly high default cycle, foreclosures have not come through. And so the inventory for investors to buy those properties has diminished. And so they're buying some of those lower affordable homes that you had talked about, maybe a little bit faster because of what they're normally getting from the foreclosure pipeline isn't there. So they're taking away opportunities for first-time home buyers. And that is something I saw in my last job, and I'm still seeing in the market today.
Yeah, and I'll tell you, you mentioned the cost of things. I think insurance is really going to be problematic, not just in areas that are hit hard, but just in general. And if you don't pay attention to that, insurance has gone through the roof. Part of it, they're going to blame on replacement costs, cost of goods and such due to inflation. But it's really, really problematic. If you own your home and you're relatively savvy, you can have high deductibles and maybe, insure to a certain level. If you've financed it, the bank's going to require you to have coverage for hazard. Not a lot of, there's some conversation in some states about it. I think it's one thing that really needs to get looked at. And then the other piece that I think is interesting, so the demographic of the first-time home buyer in the olden days was, I've got a job, whether it's at a company or the factory or whatever it is, and I grew up in this town, and I'm going to go ahead and and get married and have kids and get a house, and I'm going to stay here. And it's, the foundation of my family. Not that way anymore, EJ. These newer generation people are very, very nomadic. And with COVID and with remote work, there's no necessary incentive to just want to put down and grow roots in any one place for a long period of time. And the fixed costs of refinancing and moving, not for refinancing, but for rather moving, you're really losing a lot of your equity immediately. And so mathematically, it's not even a good financial decision necessarily. And so, it's hard to say how it's going to play out. There's certainly a lot of money being put into it through the not-for-profits and the government entities. But at the same time, I think we've changed a bit as a society, and I think that those things are probably going to stay that way. So, we've had a good talk today. It's been really interesting listening to your perspectives, and of course, I have mine too. But if you were, wanted to mention anything else before we wrap it up, is there anything else that you wanted to discuss or bring up before we close out today?
Yeah, obviously, and I agree, it has been a really good conversation. And I always look forward to your insights, especially, you and I have very similar backgrounds. I think to me, what the Fed's going to do in an election year with 2 more meetings, I'm definitely keeping an eye on that. And, to your point, I think home ownership, which was a dream for many, might now not be that same dream because, like you said, they could be nomadic. They can live anywhere. They can work from home. And during COVID, they moved out to rural areas, which problematic itself. There's just not a lot of inventory out there. So I guess I'm going to look at what people are doing that are in homes today. I'm concerned that they are using their equity that they've now seen over the last 5 or 6 years and beyond to get home equity lines of credit because they don't really want to get out of a 3% mortgage and go into a 7% or 6.5% or even 5.5%. Just to them, it doesn't make sense to them. And just in my local area, again, I've seen people do some new construction on their homes. They're putting in patios, they're putting in pools, and those are not small ticket items. And what that does from a default servicing perspective is it reduces the equity you have in your home if the market does turn slightly or stabilize. So you might be sitting on 40% equity, but that could dwindle away pretty quick. Now HELOCs are appealing because they're variable rates, and as the Fed does cuts, it's a little cheaper to borrow that. So that to me is just going to be interesting how that changes the dynamic of the default space in the coming years. And I think if short-term memory is what I think it is people have forgotten what 2008 did, and they're going to be potentially in a situation where they're underwater or not having enough equity to do what they want to do.
Yeah, that's real interesting. And of course, just wanted to remind everyone that listens to our podcast, you can go find out a lot more information about Actualize at our website. You can look to see some of the things that we do. And as a big reminder, we are incredibly oriented towards affordable lending with our customers, with the offerings that we make to those customers and to the entire housing community. So with that said, that'll wrap it up for today. Thanks, EJ, for your time, and we look forward to talking again.
Thanks, Matt.
Thanks for joining us for today's episode of Actualizing Success. Make sure to visit us online at www.actualizeconsulting.com, where you can explore our service offerings. Don't forget to subscribe to the show on iTunes, Spotify, or your preferred platform. If you've enjoyed what we talked about today, please consider leaving a review and following us on LinkedIn. If you have any questions or would like to share your opinions with us, please send us a note at podcast@actualizeconsulting.com. We look forward to hearing from you.